The latest gross domestic product, or the GDP data, the National Statistics Office has released on November 20th, showed that India has actually slipped into a technical recession. Now, let's explain what a technical recession is. An economy is technically told to be in a recession when its GDP actually contracts in two successive quarters. This is real or inflation-adjusted GDP that we are talking about. And this has happened in India for the first time in 41 years that India has actually slipped into a technical recession. In the first quarter, we saw the GDP actually contract by 23.9%. And now in the second quarter, it has contracted by 7.5%. So these are two successive quarters of contraction could imply that India could actually be heading for a full year fall in GDP for the first time in 41 years. When was the last time actually India had a full year fall in GDP? That was in 1979. But amid all these darkening clouds, there's a glimmer of optimism. Is that this fall has come on the back of an even steeper plunge when the GDP actually fell 23.9% in April, June. And from a fall of 23.9%, the fall has actually, or the shrinkage has come down to minus 7.5% in July to September. In current prices, the picture looks slightly better. GDP has contracted 4% over the corresponding quarter of the previous year, compared to 22.6% fall in the first quarter. But there are other positive signs as well. There are at least three sectors that have done well. One is agriculture, and that was quite expected. Agriculture would grow because there was a bountiful harvest. The monsoon rains were plentiful, and the kharif crop has done well. So that's fine. But the big takeaway is the manufacturing sector. It has grown 0.6% in July to September compared to the same period last year. What does it tell us? It tells us that the activity in factories across the country have actually been more or greater compared to July, September last year, when the economy was actually in a far rosier shape than what we see now. That's an extremely encouraging sign, and that has beaten all expectations, that has beaten all estimates. And this is something, the challenge is now obviously to sustain this momentum. In the rest of most of the rest of the sectors, actually, the sectoral GDP has contracted. We have seen that happen in construction. We have seen that happen in trade and hotels. We have seen that happen in finance and real estate and various other sectors. But in most of the sectors, which despite reporting a negative contraction, there is one common thread that runs to it. And that is, again, is a very encouraging thread and a very promising thread. The thread is that it has the shrinkage or the extent of contraction have actually dramatically got reduced compared to the previous quarter. That is, the contraction in July, September in most of the sectors is lower. In fact, in many sectors, far lower than what it was in April to June. What does it tell us? These numbers are very strong markers of an economy that is in an expansionary phase. And it might sound a contradiction or a paradox of sorts when I say that the economy has entered an expansionary phase. How can I say that an economy has entered in an expansionary phase and most sectors have actually reported negative growth? The reason is that, as I said before, the extent of contraction in most of the sectors have been far lower compared sequentially to the previous quarter. So that means activity has actually started returning to these sectors. And I would not be surprised if we actually return positive growth in the Jan-March quarter. In fact, this data is for July, September. We are now in November, end of November, and we'll soon be entering the last month of the next quarter, that is the October-December quarter. And that is when anecdotal and shop-end data have actually shown that it was far better than the previous quarter. That is, if you look at sales, for instance, there are far more cars that were sold. More people have got onto roads. And how do we know that? Because petrol and diesel sales have actually gone up in October compared to, say, September or in the previous months. But there's a big number that stands out in all of this. That is the GST collection data. Now, GST collection data collections have actually crossed 1 lakh crore in October for the first time since the pandemic set in March. And GST, as we know, by definition, is a destination-based tax. So if more GST has been collected, it would effectively mean that people are buying more goods and services. That's a good sign. These are very encouraging signs of green shoots across the economy. But can we sustain the momentum? Yes, we can, but there are a few conditions. In fact, there is one singular condition that we need to fulfill for this momentum to sustain, and that is entirely up to people. It's the citizens of this country, is adherence to COVID appropriate behavior. People will have to mask up, people will have to maintain hand hygiene, and people will have to maintain social distance. Masking up is absolutely critical for the economy to turn positive. Otherwise, there's always a possibility of slipping back again into severe contraction, a risk that the country cannot take, because there is, if the country were to slip, or if another round of lockdowns were to impose, it's going to have a debilitating and a devastating impact on the economy. So the big lesson from here is the economy has opened up, the economy is showing signs of recovery, the revival signs are very strong, but it's up to people now. Mask up, mask up, mask up.